Happy Monday, everyone, and welcome to episode 8 of Modern Investing Techniques. I'm Patrick, coming to you from Vancouver. Today is March 30th, 2026. A brand new week is in front of us, and as always, we're going to cut through the noise and look for the practical edges that busy professionals can actually use in their own portfolios. Before we go any further, the standard but important disclaimer: everything we discuss on this show is strictly for educational and entertainment purposes. The practice investment of the day uses simulated trades with no real money at risk. I am not a licensed financial advisor, this is not financial advice, and nothing here should be taken as a recommendation to buy or sell any security. Always do your own research and consult a qualified professional before putting any of your hard-earned capital to work. Past performance does not predict future results, and markets involve real risk of loss. Here's what. That's making news in the modern investing techniques world today. Because the news flow was unusually thin this week, we're going to turn the entire episode into a full-length educational masterclass. Today we are mastering the covered call ETF strategy in this current sideways choppy market environment that many of us have been living through. Let's stop. RT with the market pulse as of March 30th, 2026. The S&P 500 closed the period with a modest single-digit year-to-date gain. The NASDAQ is sitting in that same modest single-digit year-to-date territory, and the TSX Composite mirrors this pattern with similar modest single-digit gains across the board. What stands out is that across all three major benchmarks we're seeing persistently elevated volatility. That volatility is being driven by constantly shifting interest rate expectations and meaningful sector rotation that has kept leadership changing hands week after week. This exact setup, prolonged sideways action combined with choppy, elevated volatility, is precisely the environment where covered call strategies have historically tended to outperform plain equity ETFs on a risk-adjusted basis. The premium income provides a cushion that dampens the emotional ride, while the modest upside capture is less painful when the market isn't delivering 20 to 30% annual gains anyway. So, with the markets handing us exactly the kind of environment where covered calls tend to thrive, let's dive deep into how these ETFs actually work, why they've exploded in popularity with busy professionals like you, and how you can responsibly add them to your TFSA, RRSP, or non-registered accounts. Covered call ETFs have seen massive inflows for one very simple reason. They solve a frustrating problem that almost every intermediate investor eventually runs into. You want reliable monthly or quarterly income from your portfolio, but you don't necessarily want to sell your underlying stocks and trigger capital gains or lose the long-term compounding potential of quality companies. The mechanics are actually quite straightforward once you understand the moving parts. The ETF holds a diversified basket of stocks, sometimes an entire index such as the S&P 500, the NASDAQ 100, or the TSX 60. On top of that equity portfolio, the fund systematically sells out-of-the-money call options against those holdings. The premium collected from those sold calls is then paid out to you as monthly or quarterly distributions. In exchange for that income, you keep the underlying equity exposure, but you typically capture only 70 to 85% of the full upside in any strong rally. That trade-off is the core of the strategy. What you get in return is a high current yield, often running between 7 and 12% annualized, depending on the volatility environment and the specific ETF. You also benefit from lower overall volatility because that option premium acts as a cushion on the downside. When the market sells off, the premium you collected reduces the net loss compared with simply owning the index outright. Typical management fees in 2026 have come down nicely and now range from 0.35% to 0.79%. A far cry from the 1.5% plus fees we were seeing just a few years ago when the category was still relatively new. The average monthly distribution yield across the entire covered call category currently sits around 8.4%, and the beta for most of these products lands between 0.65 and 0.85 versus their benchmark index. That lower beta is exactly why many professionals use them as a volatility reduction tool inside an otherwise growth-oriented portfolio. On the Canadian side, some of the most popular tickers you'll see in investor accounts include the BMO suite, ZWC, ZWU, and ZWE. For NASDAQ exposure, Nuveen's QQC and QQC. To have built a loyal following, Horizons also offers HXDM and HXD in the covered call space. More recently, several enhanced covered call ETFs have moved away from strict monthly option cycles and are now using 30 to 45-day options. This slight extension allows the managers to capture higher premiums when volatility spikes and gives them more flexibility in strike selection. South of the border, names that are easily accessible through Canadian platforms include JEPI, still the heavyweight in the large-cap U.S. covered call category, and its NASDAQ counterpart, JEPQ. Global X continues to see strong usage of both XYLD and QYLD, while RILD and KNG round out many investor sleeves. The sheer variety now available means you can tailor the strategy to almost any sector or geographic exposure you want. Now that we understand the mechanics, let's get practical and talk about when these ETFs shine, when they disappoint, and the critical tax rules every Canadian investor absolutely must know before allocating a single dollar. Covered call ETFs tend to shine brightest in sideways or only mildly bullish markets, the exact kind of environment we lived through for much of 2025 and have carried into the first quarter of 2026. They perform especially well when implied volatility is elevated, with the VIX trading above 18 or its Canadian equivalent showing similar stress. In those higher volatility regimes, the premiums are fatter, which translates directly into higher distributions for you. The strategy also makes a lot of sense when you need tax-efficient monthly cash flow inside a TFSA or RRSP. Inside those registered accounts, the distributions are completely tax-sheltered, which is a massive advantage for Canadian investors who want steady income without creating a tax headache every year. That said, these products do lag meaningfully in strong bull markets. Just look back at 2023. Many covered call ETFs delivered total returns in the 9 to 14% range, while the NASDAQ 100 gained well over 40%. You are deliberately giving up some of that upside in exchange for the income and the lower volatility. It's a conscious trade-off, not a flaw. In sharp downward crashes, the premium cushion helps blunt the loss, but it certainly does not eliminate it. If the market drops 25%, you might still be down 15 to 20%, better than the index, but still painful. On the tax side, things get more complicated outside registered accounts. In non-registered accounts, the option premium is generally taxed as ordinary income, which makes these ETFs far less attractive unless you're in a very low tax bracket. You also have to be mindful of the superficial loss rules if you simultaneously hold the underlying individual stocks in the same account. That can create unexpected tax complications if you're not careful with your cost-based tracking. When it comes to portfolio construction, I suggest limiting covered call strategies to a maximum of 25 to 35% of your total equity allocation. That keeps the income and volatility reduction benefits without turning your growth engine into an income-only vehicle. I like blending US and Canadian covered call ETFs to help manage currency risk. Pairing them with growth-oriented ETFs or individual momentum names helps offset the upside you're voluntarily sacrificing. Rebalancing that sleeve once per year inside your TFSA or RRSP keeps things tidy and prevents any single strategy from dominating. We're also starting to see the next evolution, AI-powered covered call ETFs that dynamically adjust strike selection based on prevailing volatility regimes. While fully automated LLM-driven option writing is still early, several new ETFs already incorporate systematic rules that widen or tighten strikes depending on realized volatility. This is an area I'll be watching closely in the coming quarters. So how do you actually pick the right covered call ETF without spending hours buried in research? Here's the exact 5-minute checklist I give every listener who asks me this question. First, identify the underlying index or sector. Are you looking at the S&P 500, NASDAQ 100, TSX Composite, or something more focused like Canadian banks or energy? Second, check the current distribution yield and, more importantly, confirm how consistent that payout has been over at least the past 12 months. Third, examine the option writing style. Is it monthly, weekly, or one of the newer 30 to 45-day cycles? Fourth, review the management fee and any noticeable tracking error versus the benchmark. Fifth, look at the historical upside capture during strong bull months. 60 to 80% capture is a reasonable target for most investors. Sixth, assess the currency exposure, hedged or unhedged, and whether that fits with the rest of your portfolio. You can run through this entire checklist in just a few minutes inside Wealthsimple, Questrade, or Interactive Brokers. Most of these platforms display the distribution history and fee data right on the ETF detail page, so the information is literally at your fingertips. The key is never to treat covered call ETFs as a replacement for broad index funds. Instead, blend them thoughtfully with growth ETFs so you still participate meaningfully when markets really start to run. Because, two, his is a special educational episode. Today's practice investment of the day is not a new weekly hold. Instead, we're going to walk through a demonstration portfolio allocation so you can see exactly how the pieces might fit together. In this simulated allocation, we assigned 15% to a Canadian-listed NASDAQ covered call ETF. 10% goes to a U.S. large-cap covered call ETF, the GPI equivalent. Another 10% sits in a Canadian bank and energy-focused covered call ETF. That brings the total demonstration sleeve to 35% of a hypothetical equity portfolio. Over the past 24 months, this kind of balanced mix would have delivered approximately 9.8% annualized income while still providing modest capital appreciation. At the same time, the sleeve experienced 30 to 40% lower drawdowns than a pure equity index during the more volatile stretches. This is purely a simulated educational example. No real money is being deployed here. The goal is simply to illustrate how the income component can help during choppy sideways markets and how the lower beta can reduce the emotional swings that come with 100% pure equity exposure. As we wrap up this masterclass, let's bring everything together with some final thoughts on how to use covered calls responsibly. Covered call ETFs are powerful tools, but they are not a silver bullet. They work best in the right market environment inside the right account type, especially registered accounts, and as part of a diversified portfolio rather than a single solution replacement for broad index funds. Stay disciplined and data-driven when you allocate to them. Keep your position sizes reasonable, rebalance regularly, and never forget that you are intentionally capping some of the upside in exchange for income and lower volatility. That trade-off is only worth making when it aligns with both the current market regime and your personal cash flow needs. This podcast is for educational and entertainment purposes only. Nothing discussed constitutes financial advice, investment recommendations, or solicitations to buy or sell securities. The practice investment of the day uses simulated trades with no real money. It is a learning exercise to demonstrate analytical techniques. Past performance does not predict future results. Markets involve risk of loss. Always do your own research and consult a licensed financial advisor before making investment decisions. The host and NARA network have no fiduciary relationship with listeners. Before we sign off, keep an eye on volatility levels this week because they will directly influence how attractive the new covered call premiums look. Higher volatility generally means richer premiums, something worth monitoring in your own research. That's it. For today's episode of Modern Investing Techniques, you'll find links to all the ETFs we discussed, plus the checklist and sample allocation on the resources page. If you're finding value here, please subscribe, leave a review, and share this episode with someone who wants to go beyond simple index fund and forget investing. Thanks for spending part of your Monday with me. I'll be back tomorrow with fresh market insights. Until then, stay curious, stay disciplined, and keep putting your capital to work smarter. Take care. This podcast is curated by Patrick, but generated using AI voice synthesis of my voice using ElevenLabs. The primary reason to do this is I unfortunately don't have the time to be consistent with generating all the content and wanted to focus on creating consistent and regular episodes for all the themes that I enjoy, and I hope others do as well.